Lesson 3, Investment Principles. Investing is the process of allocating money into assets with the expectation of generating returns over time. By understanding various investment options, individuals can build a diversified portfolio that aligns with their financial goals and risk tolerance. Stocks, also known as shares or equities, represent ownership interests in a company. When you buy a stock, you become a shareholder and gain a claim on the company's assets and earnings. There are two main types of stocks: common stocks and preferred stocks. Common stocks give shareholders voting rights and the potential for capital appreciation, while preferred stocks offer a fixed dividend payment and priority in the event of liquidation. Investing in stocks can provide potential capital appreciation, dividend income, and portfolio diversification. Stock investments carry the risk of price volatility and potential loss of capital if the company underperforms or goes bankrupt. Bonds are debt securities issued by corporations, governments, or other entities to raise capital. When you buy a bond, you are essentially lending money to the issuer, who agrees to pay interest periodically and return the principal amount at maturity. Bonds can be categorized by issuer: corporate, government, municipal, credit quality, investment grade, high yield, and maturity, short term, intermediate term, long term. Bonds provide regular interest income, lower volatility compared to stocks, and can act as a hedge against economic downturns. Bond investments carry risks such as interest rate risk: prices fall when interest rates rise; credit risk: the issuer may default on interest or principal payments; and inflation risk: reduced purchasing power of interest payments over time. Mutual funds pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other assets, managed by a professional fund manager. There are various types of mutual funds, including equity funds, investing in stocks, bond funds, investing in bonds, and balanced or hybrid funds, investing in a mix of stocks and bonds. Mutual funds offer diversification, professional management, and ease of investment, making them suitable for investors with limited time, knowledge, or capital. Mutual funds carry risks associated with the underlying investments and may be subject to management fees, which can reduce returns. By understanding the characteristics, benefits, and risks of stocks, bonds, and mutual funds, individuals can make informed decisions about their investment choices and create a diversified portfolio tailored to their financial goals and risk tolerance. This knowledge is essential for achieving long-term financial stability and wealth accumulation. Diversification and portfolio management. Diversification is the practice of spreading investments across a range of assets, sectors, and geographic regions to reduce overall portfolio risk. By diversifying, an investor can minimize the impact of a poor-performing asset on the overall portfolio, as losses may be offset by gains from other assets. Diversification helps to manage risk by reducing the potential for large losses due to a single investment or market event. It also increases the likelihood of capturing returns from various sources, which can enhance long-term portfolio performance. Asset allocation is the process of dividing a portfolio among different asset classes, such as stocks, bonds, and cash, based on an individual's financial goals, risk tolerance, and investment time horizon. When determining an appropriate asset allocation, consider your investment objectives, for example, retirement, college savings, time horizon, short-term versus long-term, and risk tolerance, conservative versus aggressive. Periodically reviewing and adjusting your asset allocation is important to maintain the desired level of risk and return. This process, known as rebalancing, involves selling assets that have performed well and buying underperforming assets to return the portfolio to its original allocation. Portfolio management involves the ongoing process of selecting, monitoring, and adjusting investments to align with an individual's financial goals and risk tolerance. Active portfolio management involves a fund manager or investor making decisions to buy, sell, or hold assets based on research, market analysis, and forecasts. The goal is to outperform a benchmark index or achieve specific investment objectives. Passive portfolio management, also known as index investing, involves tracking a market index or sector by holding a portfolio that replicates the composition of the index. The goal is to achieve returns similar to the benchmark index, typically with lower fees and turnover than active management. Effective portfolio management includes monitoring and managing risks, such as market risk, interest rate risk, currency risk, and liquidity risk, to protect your investments and ensure your portfolio remains aligned with your financial goals. By understanding the concepts of diversification, asset allocation, and portfolio management, individuals can build and maintain a well-balanced investment portfolio that aligns with their financial goals and risk tolerance. This knowledge is essential for achieving long-term financial stability and wealth accumulation. Risk and return risk refers to the potential for loss or variability in the value of an investment due to factors such as market fluctuations, economic conditions, or company-specific events. Some common types of investment risks include market risk, general market fluctuations, credit risk, potential default of a bond issuer, interest rate risk, changes in interest rates affecting bond prices, liquidity risk, difficulty in buying or selling an asset, and currency risk, fluctuations in exchange rates impacting foreign investments. An individual's risk tolerance is their willingness and ability to accept fluctuations in investment returns. Factors that influence risk tolerance include financial goals, time horizon, and personal temperament. It is crucial to assess your risk tolerance before making investment decisions. Return is the profit or gain on an investment, typically expressed as a percentage of the initial investment. Returns can be realized through capital appreciation, an increase in the asset's value, or income, dividends, interest payments. Investment returns can be measured in various ways, such as absolute return, total gain or loss, annualized return, average return per year, or risk-adjusted return, return relative to the level of risk taken. The risk-return trade-off is the principle that higher potential returns come with higher levels of risk, and lower potential returns are associated with lower levels of risk. Investors must balance their desire for higher returns with their tolerance for risk. Diversification helps manage the risk-return trade-off by spreading investments across a variety of assets, which reduces the overall portfolio risk without sacrificing potential returns. Asset allocation plays a significant role in determining the risk-return profile of a portfolio. Allocating a higher percentage of the portfolio to stocks typically increases the potential for higher returns but also comes with increased risk, while a larger allocation to bonds may provide more stable returns with lower risk. By understanding the relationship between risk and return, investors can make informed decisions about their investment strategies and create a diversified portfolio that aligns with their financial goals and risk tolerance. This knowledge is essential for achieving long-term financial stability and wealth accumulation. Importance of asset allocation. Asset allocation is a crucial component of investing, as it determines the overall risk and return profile of a portfolio. By allocating assets appropriately, investors can optimize their portfolio performance based on their financial goals, risk tolerance, and investment time horizon. Strategic asset allocation is a long-term approach that involves setting target allocations for different asset classes based on an investor's financial goals, risk tolerance, and time horizon. The portfolio is periodically rebalanced to maintain these target allocations. This approach provides a disciplined, systematic method for managing investments and maintaining a well-diversified portfolio. It also helps to reduce the impact of market fluctuations and emotions on investment decisions. Tactical asset allocation is a more active approach that involves making short-term adjustments to a portfolio's asset allocation based on market conditions or specific investment opportunities. This strategy aims to capitalize on market inefficiencies or trends to enhance portfolio returns. Tactical asset allocation can potentially generate higher returns by taking advantage of market opportunities. However, this approach requires a higher level of investment knowledge, skill, and ongoing monitoring. Age-based asset allocation is a strategy that adjusts the portfolio's asset mix based on the investor's age, gradually shifting from a more aggressive allocation, higher percentage of stocks, to a more conservative allocation, higher percentage of bonds, as the investor approaches their financial goal or retirement. This approach helps to balance risk and return over time, ensuring that the portfolio remains appropriate for the investor's changing risk tolerance and time horizon. Dynamic asset allocation involves adjusting a portfolio's asset allocation in response to changing market conditions, economic indicators, or investment opportunities. The goal is to manage risk and capitalize on market trends to improve returns. Dynamic asset allocation can provide flexibility and adaptability in managing investments, potentially improving performance during different market cycles. However, this strategy requires a higher level of expertise and active monitoring. By understanding various asset allocation strategies, investors can choose the approach that best aligns with their financial goals, risk tolerance, and investment time horizon. Implementing a suitable asset allocation strategy is essential for optimizing portfolio performance and achieving long-term financial stability and wealth accumulation. Passive and active investing are two distinct approaches to portfolio management, each with its own set of advantages and disadvantages. Investors must weigh the benefits and drawbacks of each method to determine which best aligns with their financial goals, risk tolerance, and investment preferences. Passive investing, also known as index investing, involves tracking a market index or sector by holding a portfolio that replicates the composition of the index. The goal is to achieve returns similar to the benchmark index. Passive investing typically involves lower management fees and trading costs, as the portfolio is not actively managed or frequently rebalanced. Passive investing often generates fewer taxable events due to lower portfolio turnover, making it more tax efficient compared to active investing. Passive investments tend to provide consistent, long-term performance that closely mirrors the benchmark index. Passive investing aims to match, not outperform, the benchmark index, limiting the potential for higher returns. Passive investments are fully exposed to market fluctuations and do not actively manage risks or adapt to changing market conditions. Active investing involves a fund manager or investor making decisions to buy, sell, or hold assets based on research, market analysis, and forecasts. The goal is to outperform a benchmark index or achieve specific investment objectives. Active investing aims to generate higher returns than the benchmark index by identifying undervalued or high-growth assets. Active managers can respond to changing market conditions and manage risks more effectively, potentially protecting the portfolio during market downturns. Active investing generally involves higher management fees and trading costs due to the frequent buying and selling of assets. The higher portfolio turnover associated with active investing can generate more taxable events, reducing the portfolio's after-tax returns. Not all active managers consistently outperform their benchmark index, making it difficult to identify and select top-performing funds or managers. By understanding the differences between passive and active investing, individuals can make informed decisions about their investment strategies and create a portfolio that aligns with their financial goals, risk tolerance, and investment preferences. This knowledge is essential for achieving long-term financial stability and wealth accumulation.